Question 2 introduces a low value exemption and is asking the community to decide whether a platform that has up to $1,000 per customer or $5 million in total assets in custody should be the maximum value after which the Australian financial services laws kick in. If the intention of the proposed low value exemption is to allow for innovation and experimentation in the early stages of a novel service offering, then that is the criteria against which the exemption should be measured against. The numbers $1,000 per customer and $5 million in total have important safety ramifications for investors, but they say nothing about the amount of innovation and business investment that is being undertaken by the firm. In other words, the figures of $1,000 per customer and $5 million in total represent the drawing of an arbitrary line in the sand and then hoping that innovation, experimentation and business investment will accumulate and aggregate below the line by itself. A more sensitive policy tool would not only be interested in protecting investors above the line, but also in proactively stimulating investment below the line. This could be achieved by having a range of low-value exemption categories instead of a single one, categories that are able to recognise the amount of investment spending undertaken by the firm over the previous year. A more sensitive policy tool could also make a distinction between retail and accredited investors that it is providing services for. Here's a sample low-value exemption table that is sensitive both to the type of investor and also to the amount of business investment that is being undertaken by the firm. The table takes a graduated approach to reporting with a full exemption applying up to $20 million in custody. Question 3 is asking about the impact of the proposed framework on AFSL brokers and whether the community feels there is any opportunity for regulatory arbitrage. Platforms that provide a wraparound AFSL custodian service for organisations undertaking a non-financial business use, e.g. gaming companies, are really providing an essential service for the digital asset sector. The advantages of the AFSL broker model are as follows. 1. Reduces in-house administration for gaming and other non-financial organisations, increasing productivity. 2. Supports the development of a healthy AFSL broker economy. And 3. Reduces education costs for the regulator, who get to deal with AFSL native brokers instead of non-financial startups without regulatory experience. Does the proposed model provide opportunities for regulatory arbitrage? There are always opportunities for digital asset firms to take their businesses either wholly or partially offshore. So one needs to let go of the idea that it's fully possible to eliminate regulatory arbitrage in our modern internet-connected society. But given all of that, we don't think that the proposed model increases the opportunity for regulatory arbitrage in Australia. What it does do is share the burden of compliance across 2 or more firms as opposed to 1. This provides opportunities for collective decision-making between AFSL brokers and their clients, which leads to improved regulatory outcomes and avoids non-financial organisations having to guess at the right regulatory decision in isolation. Question 4 is asking about the percentage of net tangible assets that a digital asset facility should be required to keep on hand to cover liquidity needs in the event of a wind-up of the firm. Wind-up costs include administrative expenses associated with the liquidation of business assets and repayment of creditors and investors as required or if possible. Having a minimum NTA reserve deposit on hand is a sensible idea, and the figures of 0.5% NTA or $5 million if performing the custody function may be sufficient for some wind-ups, yet also could be insufficient for others. The prices of digital assets can routinely vary by up to 70%. This makes the requirements for a stable nominal value of reserve deposit more complex. For example, in order for custodians to remain compliant to a hard $5 million value of assets, they may be forced to purchase new digital assets in a falling market. While it is convenient for digital asset service providers to have a high percentage of their holdings in digital assets, the interests of investors could be better served if a reasonable proportion of these assets were held in off-chain traditional assets such as bonds, treasury notes, and cash, and other non-digital assets. Some digital asset service providers may argue that private stablecoins can fulfill this function. However, Terra Luna showed us that even trusted stablecoins can lose their peg and go to zero if they are not at least partially collateralized with off-chain assets. It is not in the interest of investors or customers if 100% of a platform's digital assets are held in a single hot wallet. Therefore, we suggest that custodial policy acknowledges the single pool risk by advocating a multi-pool strategy. Each digital asset platform or service provider will seek autonomy in how they establish a multi-pool custody strategy that is sensitive to their needs. Nonetheless, having some sample distributions could help to guide and clarify the type of spreads that the policy wishes to advocate. Question 5 is asking, should part of the financial advice framework be expanded to non-financial digital assets? A great number of digital asset scams either 1. Directly pay social media influencers to promote or shill a scam project, or 2. Brute force and hack their way into the social media accounts of influencers to post fake endorsements about their scams that cause widespread social harms and exploit investors. On the other hand, the influencer market is valued at $21 billion globally and growing, making a potential takedown of social media posts about irresponsible investment advice impractical and almost impossible. A social media post that promotes an investment is not by itself harmful, unless a reasonable interpretation of the content creates unreasonable expectations about the likely performance of the investment. For example, in the case of a scam project, the suggestion of any positive return is malicious and designed to hurt investors. In the case of other projects, a suggestion of a super profit, e.g. 100x, may exploit people who are in financial hardship and are hoping to gamble their way out of it. Ideally, digital assets financial advice should contain the following in addition to a claim. 1. A rationale that supports the claim being made, and 2. A disclaimer that encourages investors to do their own research and warns them that they could lose all their money. Question 7 is asking about minimum standards for asset holders who provide a custody service for digital asset facilities. Yes, we agree with the proposal to set minimum standards for asset holders, and we also agree with the proposal to tailor these minimum standards to permit bailment arrangements and require currency to be held in limited types of cash equivalents. The discussion paper asks the following questions. The minimum standards for asset holders would require tokens to be held on trust. Does this break any important security mechanisms or business models for token holders? What would be held on trust? Tokens are held on trust by the platform provider, who maintain a record of the tokens and notify the customer if any changes are required to the asset to keep it current. For example, a platform could notify a customer that a token in their portfolio is bridging to a new smart contract, and that the bridging process will be carried out by the platform on behalf of the customer unless that customer instructs the platform not to do so. Therefore, a platform provider is holding the following 3 items on trust. 1. The tokens. 2. A record of the customer's token balances. And 3. Administrative information about the transferability of customer tokens. Question 8 is asking what additional standards should apply to the holders of digital asset tokens. The inference in the discussion paper is that a digital asset service provider may use a single software platform to manage the custody for all of their digital assets. We don't believe this is a wise or responsible position because digital assets, 1, have a higher risk profile than off-chain assets. 2, may be hacked or stolen near anonymously. 3, can experience liquidity issues that reduce their tradability. And 4, may be upgraded or become unusable in their old form. For these reasons, and also as we outlined in our answer to question 4, digital asset custody should be spread in a multi-pool strategy to defray the risk of using a single provider. While custody platforms can provide smooth asset purchase, disposal and reporting, they may not be able to provide the diversity of assets that a customer is seeking. For example, a digital asset investment fund that is looking to purchase undervalued microcap projects for its portfolio may not be able to access these purchases via a custodial platform that only offers well-known token projects that are already highly subscribed by investors. We believe it's important for platforms to provide information to customers about the withdrawal process, including any restrictions that could impede a customer's access to their tokens in a timely manner. Ideally, platform providers should list all the cases under which withdrawals could be paused temporarily or stopped indefinitely. Otherwise, unconscionable providers could make arbitrary decisions about how and when they will stop withdrawals on certain tokens, thereby taking possession of customer assets. Digital asset platforms could provide their withdrawal conditions or framework to customers inside the facility contract that sets the terms of service for the platform. Digital asset platform providers need to make adequate provisioning for social media-fueled bank runs that occur from time to time in the digital asset market. Such events require platform providers to have sufficient assets on hand to facilitate the timely redemption of customer tokens. During a bank run, those customers who are able to get in first withdraw all their liquidity at the expense of those coming in later. Regulators could ask platforms to provide information about temporary liquidity strategies and facilities they have established or are establishing to deal specifically with social media-fueled bank runs. Hard forks, token contract upgrades, and the removal of trading pairs and liquidity can be controversial, but nevertheless regularly occur in the digital asset market. If token holders aren't regularly checking their account status, including emails from their platform provider, then the transferability and redeemability of their tokens may decline or cease to operate over time. In order to avoid such problems, platform providers could specify inside the facility contract that customers must service their accounts on a regular basis to take any administrative actions or make choices that are necessary. Question 9 is asking whether all digital asset platform providers should share the burden for market misconduct reporting and enforcement. At first glance, the idea for spreading the burden of liability for identifying market misconduct sounds sensible because it involves the entire digital asset community and makes it more difficult for bad actors to conceal their activity. Despite the obvious appeal of such a policy, securing appropriate levels of engagement from the digital asset community in monitoring market misconduct requires careful consideration about the incentives to report bad actors. Presently, for most market participants, the cost of not reporting a bad actor is zero, as there are no incentives in place and therefore no opportunity cost to remain silent. In contrast, the United States has a well-established system in place of rewarding people or whistleblowers who come forward with information about financial bad actors. Data shows that whistleblowers are extremely effective in generating high-quality tips that lead to successful financial misconduct prosecutions. As you can see from the graph, civil recovery from whistleblowers in the US is more than double that collected as a result of government investigators. Additionally, the SEC estimate that $1 billion of whistleblower reward payments have generated more than $6 billion of financial remedies against bad actors. The act of coming forward means whistleblowers can experience financial hardship through the lack of employment that follows. Moreover, their families can be vulnerable to revenge actions and reprisals from those they have outed. The US Dodd-Frank Act requires payment to whistleblowers of between 10 and 30% of the monetary sanctions collected, as long as they assist with the prosecution. Unfortunately, the Australian Corporations Act has whistleblower rights and protections, but not rewards. It's there in black and white on the ASIC website, and I quote, "Unlike some countries, whistleblowers in Australia are not eligible to receive a financial reward for the making of a whistleblower report. The Corporations Act does not allow for it." When one considers the size of the scams and hacks that are being perpetrated in the digital asset industry and the organised criminality of the bad actors involved, is it realistic for policymakers to expect platforms and individuals to take the personal risk of reporting on these bad actors without some form of potential compensation? In other words, the US is having success against the market misconduct economy because it has established an effective whistleblower economy that is incentivized to undermine it. Incentives that send a strong market signal to people with critical information about bad actors to come forward and play an active role in the identification and prosecution of market misconduct. If Australian financial regulation continues without establishing an effective whistleblower economy, do we risk becoming an island of easy, attracting digital asset scammers from all over the world to set up here because there's no one brave or incentivised enough to adopt them in? Another item for review in the Corporations Act is that the definition of whistleblowers, i.e. as a former employee, family member or supplier to a regulated entity, is too narrow to accommodate whistleblowers reporting on unregulated digital asset scammers. Therefore, we'd like to recommend the following changes to the Corporations Act. 1, to introduce a whistleblower payments framework, and 2, to update the whistleblower definition to be inclusive of anyone reporting about unregulated entities such as digital asset scammers and hackers.